Welcome back to Stock Kong Invest and Analysis, where we look at the market and break down the opportunities.
Like and subscribe!
This is how you value Tesla. This article was written by Hunting Alpha. Summary. Pause. Tesla Inc. is making promising progress on scaling robotaxis, with unsupervised rides beginning in Austin and further rollout updates likely to dominate the upcoming earnings call. Favorable revenue mix shifts toward robotaxis and FSD subscriptions could structurally expand Tesla's gross margins from sub 20% toward 40 to 50% over the long term. A reverse DCF and segment-level earnings build suggests Tesla's current valuation embeds roughly 24% earnings compound annual growth rate over 15 years. Granular 2040 earnings estimates for robotaxis, humanoid robots, and legacy auto plus energy add up to about $159 billion of potential annual earnings, which is slightly above what the market is implying. Technical analysis of TSLA versus the S&P 500 shows a pattern of higher lows and a potential breakout setup, indicating a constructive near to medium-term risk-reward profile. Performance assessment. Tesla Inc. TSLA has slightly lagged the broader market index since my last article on the stock thesis. Tesla is due to release its Q4 FY25 results on Wednesday, 28 January. Here's how I'm looking at the stock ahead of this earnings release. Tesla is making promising progress on scaling robotaxis. Favorable revenue mix shifts allow for gross margin expansion. Believe it or not, the valuations are reasonable. TSLA, S&P 500, SP 500 may be ready to break out to the upside. Tesla is making promising progress on scaling robotaxis. In the last quarter's earnings call, Musk stated that they expect robotaxis to be running without the supervision of safety drivers by the end of 2025. But we are expecting to have no safety drivers in at least large parts of Austin by the end of this year. So within a few months, we expect to have no safety drivers at all, at least in parts of Austin. CEO Elon Musk in the Q3 FY25 earnings call. As Musk has a tendency to overpromise and deliver late, I believe it is a big success for them to hit this milestone just 1 month later than forecast. Unsupervised robot taxis for Tesla is a major validation of the company's cameras-only approach. This strategic choice makes production more cost-efficient and scalable than Alphabet's Google Waymo, which relies on expensive LiDAR technology. In the upcoming earnings call on January 28th, I would be keen to hear updates showcasing continued momentum in the robot taxis rollout. In my opinion, this is the single biggest narrative driving the value of TSLA stock right now. Notice that some longtime Tesla bulls are banking on adoption rates surprising to the upside. We're keeping an eye on how quickly Tesla's footprint is expanding here, and it's expanding a lot faster, I think, than many people expected. So I think this is actually going to happen faster than most analysts think. In terms of the proliferation of robotaxis, especially if we get more federal legislation instead of just state by state. ARK Invest CEO Cathie Wood. Favorable revenue mix shifts allow for gross margin expansion. The robotaxis business utilizes software to monetize a physical asset multiple times. Hence, as the robotaxi ramp scales up and FSD subscriptions grow, I believe there is a strong case for the company's traditional automotive gross margin-focused profile of sub 20% to something closer to 40 to 50% over the longer term, still lower than the typical 70% or 80% in software businesses due to the hardware aspect of the robotaxi vehicles. Believe it or not, the valuations are reasonable. Ignore TSLA's 231x 1-year 5-word PE in the chart below. What we must focus on is the range of multiples for its comps. Let's do a reverse DCF. I call it reverse DCF because in form and function it is one, but instead of cash flows, I'm using earnings as the key driver for Tesla to find out exactly what the market is implying about the stock's growth expectations. This is the implied growth compound annual growth rate formula. I'll take a risk-free rate of 4.2% and an equity risk premium of 4.4%. That gets us an implied U.S. market return of 8.5%. Now let's respect CEO Elon Musk's track record in continuously building large new businesses in new industries, by assuming a higher steady-state PE multiple of 35 times. I think that is reasonable, as it is just mildly above other megatech businesses' PE multiples in the low 30 times range. And for the time horizon till the steady state, I'll assume 15 years. I think this is long enough to let a lot of the economics of the robotaxi business and some part of the humanoid potential to materialize. With these assumptions, we get an implied 15-year earnings compound annual growth rate of 24%. I think it's easier to think about this from the perspective of the final TTM earnings run rate 15 years from now, in 2040. The calculation above says that's $148 billion. So what this means is that for TSLA stock to merely earn a market-level return over the next 15 years, the company needs to have a 35 times PE multiple in 2040 with an annual earnings base of $148 billion. Is this reasonable? I'll break it down by digging into the earnings potential for each of Tesla's three big bets: the robotaxis business, general-purpose humanoid robots, and the existing automotive and energy businesses. Robotaxis. Some industry estimates peg the global robotaxi market to be worth $1.4 trillion by 2040, with Tesla taking around 35% market share. I'll be a bit more conservative and assume 25% market share at the same total market size. That gets us annual revenues of $350 billion coming from robotaxis for Tesla in 2040. Now for the net profit margins, I'm assuming 25%, as it seems reasonable for a software-driven physical service product. For context, ARK Invest estimates 32% EBITDA margins for Tesla's robotaxi business. Ultimately, that gets us a robotaxi annual PAT contribution in 2040 of $88 billion. Humanoid robots. The general-purpose robotics market, which humanoid robots fall under, is expected to be worth $370 billion by 2040. Given its early leadership with the Optimus robot and Tesla's deep, pioneering manufacturing expertise in EVs, I believe 25% market share by 2040 is a reasonable estimate. This gets us an annual revenue base of $93 billion. As humanoid robots are also a software-driven physical product like robotaxis, I will assume the same 25% PAT margins. So overall, Tesla's humanoid robot PAT contribution in 2040 comes to $23 billion. Existing automotive and energy businesses, I'm taking a 15% earnings compound annual growth rate for these businesses on account of the fact that the EV and clean energy transitions are still major long-term growth themes today. Applying this to the current base of $5.9 billion PAT gets us a $48 billion PAT contribution by 2040. Putting all this together, we get a total 2040 PAT estimate for Tesla of $159 billion, which is a little bit, 7.2% higher than the $148 billion implied by the reverse DCF analysis. So looking at it in this reverse DCF plus granular business potential estimates way, I think TSLA stocks valuations seem reasonable, but the limited upside indicates a low margin of safety for adopting a bullish view. TSLA SPX 500 may be ready to break out to the upside. If this is your first time reading a Hunting Alpha article using technical analysis, you may want to read this post, which explains how and why I read the charts the way I do. All my charts reflect total shareholder return as they are adjusted for dividends, distributions. Relative read of TSLA versus SPX 500. The relative monthly charts of TSLA versus SPX 500 show us a sequence of higher lows, which I interpret as a sign of desperation and enthusiasm by the buyers to bid the ratio prices up. The low volatility hold setup, supported by a clean, bullish engulfing candle before the monthly resistance level, also looks like a favorable setup for an impending breakout to the upside. Takeaway and positioning. My analysis of Tesla has increasingly focused more on the robotaxi's business potential and a humanoid robot growth optionality, and less on the ebbs and flows of the existing automotive business. But nowadays, I truly believe the Tesla story hinges upon the success or failure of the company's new growth bets. And looking at TSLA stock through this lens, my valuation analysis suggests close to fair pricing. This may seem shocking to investors who only look at the over 200x one-year forward PE. But as I have stated before in coverage of other high-growth names such as Palantir and Rocket Lab, you cannot analyze these kinds of stocks looking at a short-term one-year forward PE. From a business perspective, It is good to see Tesla rapidly making progress on scaling robotaxis, unlocking milestones such as unsupervised self-driving in Austin, Texas. I think further updates on the rollout will be the most important thing to focus on in the upcoming earnings call on Wednesday. The charts signal a bullish possibility as the ratio prices on TSLA versus SPX 500 may be ready to break out to the upside. Overall, I rate the stock as a market perform hold despite a bullish fundamental stance due to a lack of margin of safety in the valuations. How to interpret Hunting Alpha's ratings? Strong outperform, strong buy. Expect the company to outperform the S&P 500 on a total shareholder return basis with higher than usual confidence. I also have a net long position in the security in my personal portfolio. Outperform buy. Expect the company to outperform the S&P 500 on a total shareholder return basis. Market perform, hold. Expect the company to perform in line with the S&P 500 on a total shareholder return basis. Underperform, sell. Expect the company to underperform the S&P 500 on a total shareholder return basis. Strong underperform, strong sell. Expect the company to underperform the S&P 500 on a total shareholder return basis with higher than usual confidence. The typical time horizon for my views is multiple quarters to more than a year. However, I will share updates on my changes in stance in a pinned comment to this article and may also publish a new article discussing the reasons for the change in view. This article was written.
Hey viewers, like and subscribe to our channel. We'll keep bringing you more insightful stock analysis. It's going to be wild.